Well, people on Wall Street, I mean, definitely love to play money morning quarterback for sure. And I know what conversation you and I had, which I am a bit curious about, is the Fed seems to be hell bent on continue to cut interest rates, but I keep watching the long end of the curve, and the 10-year now up at like 4.25%. I was recording this, which I feel like my guess is, and I could be wrong. Your view on longer term interest rates is they're going up.
This is called pattern recognition, which is one step or two steps down from astrology. But it's just observing the past. And you can check me on the book you have, perhaps by your bedside. It's called The History of Interest Rates by Sidney Homer and Richard Silla, right?
Right next to the Bible, Jim, but go ahead.
Correct. Yeah. And if you take a look at that, you'll see that interest rates in the past have described decades-long periods of rising and falling. No other important critical price that I know of has exactly this characteristic. But the last 30 years or so, the 1800s, rates worked lower, and then the first 20 years of the 20th century, they worked higher. And then from the 20s and 30s, that was the Depression years in the 30s, and they worked lower again. 1946. And 1946 began what would prove to be a 35-year bond bear market. Rates began at like 2.25%.
Right.
1946. And they ended in 1981 at 15% in the long Treasury. 15%. Who can imagine such a thing? And they retested that high in 1984. That was the year of Reagan's re-election. You could buy a zero coupon Treasury to yield like 14% in May of that year, May of 1984. This was a retest of the highs, and one could see in retrospect. And, the bonds were priced like, I don't know, like a 15 cents in the dollar, and they would work their way. They would pull to par over the course of 30 years with maybe a 25-year call protection. But that was like 13, 14% internal compounding, a really terrific equity rate of return without equity risk. This takes us to the start of the great bond bull market, 40 years beginning in 1981 of falling rates, ending in 2021 or 2022, depending on how you date it, at like $18 trillion worth of securities worldwide, priced to yield less than nothing.
Yeah, I remember you writing about the Argentinian bond. There was like a 100-year bond that was yielding, what was it, like 1.2% or something?
Yeah. So this is the pattern that is there for anyone to inspect. All right, so we had what I regard as a major top in yield, in price and bottom in yield in 2020 or 21 or 22, and now people are perhaps naturally champing at the bit for rates to return to those old levels because it's been 40 years of conditioned experience in falling rates. Imagine you had like 3 successful careers on Wall Street,
and you never
or 5
experienced
really successful careers on Wall Street. And only thing you knew was fall as rates fell. That's what bonds did for a living. They fell in yield and rose in price.
Do you see, I guess, reading the tea leaves, as you are, with a little astrology in there, hopefully, do you think the 10 years going well above 5%? I mean, where do you think interest rates and inflation are going based on?
Don't pry, Ryan.
I want to know, Jim.
I wasn't born yesterday. I'm not going to give you levels. Let me reiterate. This is the future is absolutely terra incognito. You can observe where things are. You can observe how the crowd is positioned. You can observe where sentiment is, and that will help you to look for asymmetric, as they call them in the fancy reaches of Wall Street, bets. That is to say, bets that pay off much more if you win than you suffer if you lose. So you're always looking for You're always looking for that asymmetric idea. Everyone's got the wrong idea except you, Ryan. You have the right idea. Inflation is by no means vanquished, as the Fed likes to think it is. The Fed desperately wants to cut rates.
Yes.
There's always somebody important to say, you see, I told you it was over. But every every time is in fact a little bit different. Otherwise, imagine how rich the historians would be. Just conceive of it.
Not a lot of rich historians for
No,
sure. Yeah.
but some of them dress well.
It's interesting because you talk a lot about history and you've been through all of these cycles where you've seen where interest rates have been. And this is something I see right now. Like you're getting young homeowners right now who are saying, there's no way I'm buying a new house with 7% interest rates. And all of their parents are saying, that's nothing. My first house is at 14% interest rates or whatever it is. And everyone's so sick of hearing that. And they're saying, there's no way it's going to go up there. I'm going to wait for it to come down. But is that something people should be thinking about is, could rates go higher from here? Is it worth still trying to go?
Let me
going for
give you
something
a
like that?
rather lame answer to that, Courtney. Rates certainly could go higher, or in a business recession, they could certainly work lower. I mean, these long trends I talked about were frequently interrupted by counter trend movements in the business cycle. You could the 35-year bond bear market had a lot of rallies, and as rates were persistently but not constantly falling. Younger people who say that they can't work it with 7%, that's not necessarily an interest rate call. It might be an arithmetic observation that their ends don't meet at 7%.
Mm-hmm.
And this very interesting fellow, Torsten Slock, right? He sends
Yeah, I
around
read
his
his stuff
daily.
sometimes.
Yeah, it's for free, which I think is a bad idea. I don't like people sending things out for free. It's
It
bad.
cheapens it. Yeah.
Yeah.
They should
Especially when
double the price of the Grand Interest Rate Observer.
hey, that's cheap at the price. But Mr. Slock put out something, I think, over the weekend. It's with him. It's 7 days a week. There's one interesting idea, and he observed that at these levels of rates and prices of houses, that first-time home buyers were as scarce as they have ever been in the marketplace.
It's a real problem. Yeah.
Yeah, we have kids and grandkids, and the one of our daughters asked where interest rates were going.
Mm-hmm.
And I said, Alice, darling, I don't want to pop this bubble, but I don't know.
Yeah.
The people are hoping, the Fed is hoping, and that inflation is by no means extinguished. That's an opinion. The Fed persists in saying that it's restrictive. You see these Fed speakers always say, well, the Fed's own measure of financial conditions, so-called, is one of the easiest readings in a long time.
Yeah.
So rates are restrictive for Alice Graham, my daughter, and her husband, Ben. Her husband's name is Ben Graham. How's that for?
The intelligent investor.
There are no accidents in life.
Which worries me because the intelligent investor is on sale now, which says that no one cares about value investing anymore.
There was a kind of a meme photo on Twitter. Somebody sent me of a guy taking up a copy of Intelligent Investor and very delicately, like this, holding it over a wastebasket. This is after Bitcoin touched $99,000 or something, or that the banana sculpture sold for $6.2 million.
But very, very good tape they used to put that banana on that.
Yes, excellent duct tape.
Yeah, the best.
So should people wait? I don't know. Unless all laws of the business cycle have been repealed, there will be a recession. And in that recession, rates will decline. Never mind that we're in a bond bear market, meaning rates go higher. And in that recession, rates will decline, house prices will decline, and there will be bargains, at least relative bargains from today. So that is certain to happen if business cycles still exist.
Yeah.
And I am of the view that yes, they do.
Yeah, I've actually had it. I think a lot of people who aren't in this business have this misconception where, oh, the Fed's lowering interest rates, my mortgage rate's going to go down. And I actually had somebody who was closing on a property, and it was the day that the Fed was lowering interest rates last time. She called me and said, should I wait to lock in my rate until tomorrow when the Fed's lowering rate? And I said, no. Longer term rates have been rising since they started lowering. And a lot of people, I think, aren't grasping that concept that's happening right now.
The interesting thing about this particular moment we're living in is that a lot of countries are seeing the return of what used to be called the bond vigilantes. It's kind of
Ed Jardini.
kind of a showbiz name that stuck. Perhaps we around this table are the only ones who look at the Fed's perhaps over commitment to lower rates and the still visible scars and signs of the recession, sort of the inflation of 2020, 21, 22, 23, and think this doesn't look good for hoping. hoping it's not generally not a profitable strategy on Wall Street.
Yeah, no hope is a tactic. But I guess in your opinion, I mean, how did you feel when the Fed said they were going to lower rates? Did you think that was necessary?
Or politicized?
I thought, we have one fall conference every year, and I interviewed Stanley Druckenmiller for this one. And he made a very good point that the Fed, in going 50 basis points, was foreclosing options, that it was poor risk management.
Yeah.
Because it didn't give itself the room to change its mind. It was now committed to a big reduction in rates, as if it knew somehow that the CPI was going to go flatline or go down. And no, he doesn't. He can't know that. He can't. The Fed couldn't know what the election would hold and what the consequences of that election might be. So so then they did 25 more in November, and now the last time I looked, the futures markets were pricing in 25 for the December 17th, I think, last meeting of the year. And this is in the context of all these crazy. One of the copies of Grants I sent you we did a front page piece on sightings of really, really extreme speculative excesses, and the headline was "View from the Crazy Train."
I saw that.
Did you look at that, Ryan? Did you commit it to memory or any part of it?
Well, it's interesting because we actually point out a lot of the same things. We've been talking a lot about MicroStrategy, just how ridiculous the leverage play on Bitcoin. And on top of that, now you have double leveraged ETFs. So you're leveraging the leverage, and you're starting to see. I guess it's a question for you, going back to history, but it seems to me like history doesn't repeat, but it does rhyme. Starting to look a lot like the late 90s in terms of some of the more mass speculative type of investments out there that just like I don't get Bitcoin. I don't know how you feel about Bitcoin, but it seems to me like it's just a pure gambling play.
Well, you should go on. There's to me, the definitive piece on Bitcoin is that of the text of a lecture produced by a man named David Rosenthal. Now, ordinarily, it's a strong argument. It's not one that in which you appeal to authority, right? David Rosenthal was the fourth hire at Nvidia, so that's pretty good authority, right? And here's a website, or I guess he had a website. But anyway, he gave in 2022, early 20, he gave a lecture to electrical engineering class at the Stanford Business School, or grad school. Anyway, it was at Stanford. And he laid out his view of the case against. And much of it was over my head. But no, I do not get Bitcoin, but I do get leverage. I do get double leverage, and I do get vertical moves powered by leverage. And what I observed over my 158 years of experience
just getting in the business.
Is that yeah? I was first a brain surgeon, but if it goes to the moon, it's coming back from the moon.
I like that.
Possibly at a still steeper angle of descent, faster. That's the adage, right? It's probably they go up fast, they come down faster. But I say this. I don't mean to sound cocky. Cocky is what you aren't. If you're properly weathered in this line of work.
Fair.
Don't get me started. The mistakes we at Grants have made, in addition to the fabulous money making, but everything is probabilistic.
Right.
Everything. I'm reasonably sure that tomorrow's Thursday, right?
Rumor has it.
That means we have here a hardened consensus on Thursday. That doesn't mean we're wrong. So you have to watch this contrary opinion stuff. And I was on another podcast, as if there were another podcast.
Yeah.
Right.
Well, that's a fair point right there, Jim. Yeah, yeah. After you've been on this podcast, it's kind of like there's not really a higher level.
This man, Rogaine, or whatever it is, who is he? Okay, so I was on a brand X a while ago, and I pointed out that Nvidia, which I was then learning to pronounce, was at 36 times revenue. I said revenue, mind you, revenue,
which is insane.
That was then. I think it's gone up since then. So one is humble before the future, and humble before the possibility that the unexpected, indeed, no, unexpected will happen. That's certain, but the possibility that that something is truly um, singular.
Yeah, so I think the question is, you're talking about singular moves, and I mean, again, you're seeing that, and I don't know if this is reminiscent or not of Cisco, what we saw in the late '90s, where the picks and shovels of the internet really benefited first. That was the first wave. Of course, that got way overvalued. It quickly went up, and to your point, quickly went down. I mean, do you see similarities today with Nvidia? It seems to me like it's overly owned, just based on all the portfolios we look at right now. The anticipation for AI spending seems like it's in perpetuity, which we know that's not possible. So at these levels, and given the fact that there's so much ownership in that concentrated Magnificent Seven, do you see that as risky? Do you see that as similar to what we saw
Yeah,
a
sure I
quarter
do, but
century ago?
I know nothing about NVIDIA except that it answers to all of uh, the symptoms of the late stages of a speculative boom, and then some. There's always, there's RCA in 1929, and all these speculative technology stocks in the 1960s, and the Nifty 50 in the early 70s. There's always some group that has been anointed by who knows whom. Uh, maybe Mr. Market himself has anointed some group every cycle to bear the weight of all the hopes and all the leverage, and then the rascality is to pull that rug out from under all those hopeful people. The question is whether the skeptical people can hold on until the rug gets yanked. What do you think, Courtney? Is that going to work? We can
See,
hope.
yeah.
Oh, wait. We decided against hoping.
And if you are under the assumption that inflation isn't under control, and I don't think we disagree with you. One thing that's talked a lot about is gold or precious metals as a way of an inflation hedge. And I think I actually saw in some of your most recent research, like you did have some thoughts on gold. And I was wondering what you thought of is that in relation to inflation, or is the moves in gold completely separate?
Well, I think it's very much a part of inflation. I'm actually, Courtney, I invented gold.
Did you? Look at that.
Yeah, I'm notoriously or famously or persistently predictable, which is not a good thing to be, actually, the predictability part. You want to be kind of a man of mystery with regard to your calls. But I have a view that gold is money, and that it is in competition with other forms of money. It's also in competition with credit, the promise to pay money.
Mm-hmm.
And the dimmer the prospects for money as it's regarded today, that is paper money, the dollar, the euro, and the dimmer those prospects, the brighter gold's prospects. The dimmer the prospects for the solidity of such credit instruments as private credit, junk bonds, investment grade bonds, priced as they are, the better it is for gold. So gold is, I would say, not so much a hedge against inflation, though some people regard it as. I regard gold as an investment in the monetary disorder that is underway. And by monetary disorder, I mean this non-system of currencies that, well, in the case of a country that we all know so well with a new president. You see the tweet over the week, tweet or a social media, a Truth Social post.
True Social, yeah, Chris's favorite platform.
Our president re-elect messaged all of us that he would not stand for the BRICS, introducing an alternative currency in competition with our mighty dollar. And if they tried to do this, that he would slap 100% tariffs on their exports to this wonderful economy of ours, and they wouldn't know what hit them. That was Donald Trump.
But the problem is you're forcing people to look for alternatives if they know the dollar's weaponized.
Yeah,
Is that the idea
yeah.
there? I guess to play devil's advocate here a little bit, I always hear the argument for gold, but if you look at that long-term chart on gold, going way back to like the early 1900s, it's a horrible investment, right? I mean, people don't talk about that enough. I feel like
No, it's not. It's not an investment. It is money. Don't forget, also from 1900, gold in 1900 was $20.67 an ounce. That was the definition of the dollar under the Gold Standard Act of that year, and that lasted until 1933-34, when Roosevelt came in and called in all the gold and kind of told Americans that he would exchange their anachronistic gold and for crisp paper Federal Reserve notes, and he would pay them the going price, which was then $20.67. Then he marked it up to $35, and $35 stuck until 1971, 72, 73, when the Bretton Woods system of fixed exchange rates. So between 1900 and 1971, the price of gold was fixed. So it was terrible. But don't forget, between 1934 and 1974, you could not own it as an American citizen. It was outlawed. Remember that? No, but you read about it. So gold it's not an investment. It's money itself. You buy it as whether you'd accumulate. I was going to say Deutschmarks. That shows how old euros or yen or Singapore dollars or whatever. So it's not an investment. It you treat it as such. I own some of it, and I think of it as money, except secretly I hope it goes up, I hope the dollar goes down. So I look at, in that respect, it's a speculation on monetary disorder, or one could look at it in a more dignified vein as an investment in monetary disorder. But it's really to look at it in the long-term chart and say it's a lousy investment.
With volatility, though, I guess that's my argument is it has the volatility of stocks, yet it has the return of less than a treasury or long term, and that's why I guess I get a little skeptical. And why would I want to own that?
The volatility of less than over what period is it more volatile than stocks?
I'm sure you could look over the last 20 years. You had several years where it was down double digits, correct?
Yes. Yeah.
That's equity-like exposure.
Yeah. Well, the mining equities are much worse than that. So it can be a treacherous. People fall in love with it, I suppose, and to a degree. I'm not actually in love with it. I've got a wife of 51 years, Patricia, with whom I
well done, Jim.
Certainly. But gold is over the very long sweep. It does well against paper. That's if you're looking at it as a form of money, and over the course of 600 years, the ancient empire of Byzantium circulated a coin called Byzant, or the Solitas, and that held its value for the 6 centuries. So you're looking for something that's going to hold its value, and it's not going to go to zero. Yeah.
Hey, hope you're enjoying the most recent episode of Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, brokerage product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review.
So I guess given between the choice of having gold in your pocket and Bitcoin, it sounds like you choose gold.
Yeah, well, I could certainly get more Bitcoin in my pocket.
Infinitely more.
Infinitely more, yeah.
There it is.
So you talked about pattern recognition. I was fortunate enough when that big spike in rates came, back in the late 70s, early 80s. I had to educate these two guys. So I funded their their college accounts with those zero coupon treasuries at those
Ah,
ridiculous yields, right?
yeah,
And I remember the hard part about being a financial advisor back then was to get people out of the 19% money market fund
yeah,
to take
yeah.
that big hit to buy a 14% zero coupon treasury.
Tigers and lions.
Tigers and lions, yes. I remember the firm I worked for, we got sued. There's a class action suit against the firm because somebody thought that one of those should have been 1/10 of 1% higher or whatever. I mean, it was just crazy. Um, but it was amazing how people were very, very strident in their view. And like, I get a guaranteed 19 without any volatility. And
Yeah.
it kind of sat there all the way through. So, looking at today's yield curve, which is really kind of flat now, if you're funding two young kids' education, I've got I have two grandchildren. I have a new grandchild coming next month. Where would you place that zero coupon?
Oh
Now,
no, that's the best of questions. And I get the worst of answers. But the most, let me say, I'll make one representation for a long dated security at these yields, which is that the reinvestment rate of the coupon is going to make it a better investment than the yield to maturity that's posted on the screen. And that was, remember in the long bond bear market, you could reinvest, you had a coupon of 8 or 9 or 10%, and the bond was going down all the time. But however, the coupon reinvested at ever the higher rates was a little bit of a silver lining. So yeah, this is perhaps a poor starting place for making a long-term bet on bonds, which is also necessarily a bet on the solidity of the dollar, right? These are all denominated in currencies. So I'm a little bit stuck at your very great question, Bob. I think that I fully agree with you that in 1984 you did exactly the right thing.
yeah.
That's my answer to your question.
Sometimes it's so easy. Like when you have a guaranteed compounded interest rate of 14%, which is 40% above the historical return to the equity market. To me, it was a no-brainer.
But as for the here and now, we at Grants think that that long-dated Treasury inflation-protected securities tips are relatively attractive in a world not very many attractive fixed income returns. They're priced such that
Inflation is going to be lower than it might be.
yeah, they're giving the Fed and the Treasury and the President and the benefit of the doubt on inflation. I forget now what the break even is, but if inflation goes much above 2 or 3%, 2.5%, maybe people can check their own darn arithmetic. But if it goes above that level, whatever it is, they will do well or relatively well. And when we last wrote about them, I guess a month or two ago, that particular level, whatever it was very fetching.
Well, you talked about a weak dollar. The dollar seems extraordinarily strong right now. What's going to change to make the dollar weaker?
Donald Trump is kind of telling people to look elsewhere, as I think Ryan pointed out earlier. If you're India, for example, pick one of the more wholesome BRICS, or Brazil, and you are instructed not to look elsewhere. What do? Prudently, you have to. So, what happens if he does impose these tariffs and people can't export to this country? They're going to get dollars in exchange. So if they don't get dollars, if there's fewer dollars around in the world, will the value of the dollar continue to rise? That's one possibility. I just think that that there is a fiscal moment of truth at hand. We have I think the interest bill on the debt this fiscal year is going to be 1.1 trillion, which is more than half, of course, of the expected deficit. There's a level of finance in which you borrow to pay the interest bill. It's called Ponzi finance.
That's a great way of describing it.
And we're kind of there, and
Yeah.
and so how bullish can one be on the particular currency? Again, keeping an open mind or trying to, the dollar does want to go up. But my goodness, I guess it's better than some others. But what happens if the yen, for example, Japan starts repatriating um, foreign investments, and the United States is a major net debtor in its investment position? What will happen to the dollar then? So it's a very complex and most excellent question. And Bob, next time we speak, I'm going to have an answer for you.
We don't need answers, Jim. Just want your thoughts today. That's
Okay.
all. We know.
I guess another question for you, Jim. I mean, maybe going back to memory lane a little bit. You've been on Wall Street for quite a few years now. Again, still getting in the game, obviously, as you mentioned. But I'm curious, like, so over your time on Wall Street, like, what to you is the same today as it's always been?
People.
In what way?
The almost irrepressible urge to do the wrong thing. Money is not humanity's best subject.
I'll second that.
God, Bitcoin's going up. There must be something there, right? Besides, this jackass who lives across the street from me has got a new car. Where do I get some of that stuff? That's as old as tulips, and I dare say that before tulips, there was, like, no doubt a mania over colored pebbles on the beach someplace. So the impulse to sell low and buy high is a permanent wiring of the human mind, and what introduces all the mystery and the music and the poetry into this line of work is that you don't know how long things are going to go on, right? What's different is, my goodness, the way you do things. Before we started talking together, Bob mentioned pneumatic tubes. When I started a McDonald company in 1967, I was 20 years old, just got out of the Navy, and I was hired as a clerk for about $60 a week. And in all the bathroom stalls, there was a brass fixture for resting your cigar, your lit cigar. And
we need to bring that back.
Orders, yeah, we need that. And orders moved very quickly by pneumatic tube. And higher bond math was knowing that yields moved inversely to prices. That was the higher level. And there were yield books to calculate. There's obviously no Bloomberg screen, so you got out the yield book with onion-like paper, very thin paper, and you kind of interpolated to what was going to be the yield on the 4.25% and Treasury 4.25% in 1992. That was the benchmark when I started. So I kind of made a round trip in interest rates from 4.25% of 1992 to the 4.25% of what? 2052. I will be 105 years old, 506 years old. So that's something. So the technology is different. People are the same. And the technology is rather a broad brush over the extraordinary up-tempo of the conduct of all operations. Wow. I mean, there's in the day, and I'm not talking about 1960, I'm talking about when grants got started in the 1980s, early 80s, we made a name for ourselves in deconstructing the junk bond prospectuses, reading them and pointing out the risk factors nobody else was interested in. And that day, the issuer and underwriter distributed full dress, 150 or 200 page prospectuses, and you really sit down and study the composition of the balance sheet and the footnotes the same and the like, and make it. And nothing like that now.
I'm sure Mike Milken didn't appreciate that you were going through those booklets.
No, he did very well in life without sharing my particular skepticism towards that asset class. But we were distant sparring partners. Although he never threw a punch. He suffered the kind of insolent musings of this. What grants? What? From Los Angeles, he was counting up his billions, and I was saying, yeah, well, you can't, yeah, but have you read page S16?
Well, I think it's also when I saw this in your latest publication, is just you start comparing like this $3 trillion market for Bitcoin, like what else could you buy for that, right? And then you're talking about, entire stock exchanges, right? You could buy for the entire Russell 2000 value or 2000 period. I think you mentioned you could bought for the entire crypto market.
These are wealth generating. These are the income generating businesses. Businesses that produce income
That's
and
really
sell a
boring,
product.
That's really boring.
Sorry, I
Yeah.
didn't mean to derail us. Also, you get, I'm not sure about you guys, but one does get tired of one's own foreboding voice. And the people get tired of hearing it. So as I'm a yes but guy in a gee whiz world. That's just how I was born. I took this up with my late mother years ago, and she said, "Yeah, that's the way it is. You're a yes but guy, and you're dealing with gee whiz people. So work with it. But you have to manage that carefully. That's in the journalism business. You can't be so predictable. So we always look for longs. We publish every 2 weeks, 12 pages, and we try to include a long, as well as many short ideas and some sardonic remarks on the state of the world and some interest rate commentary. Nothing like telling people they don't want to hear. That's that's not typically the shortest road to riches, but it's done okay for us.
So I want to shift gears a little bit and talk a little bit about history. So when you graduated college in Indiana, was it your intention to get in the finance world, or did you intend to get into the literary world?
I wanted to get into. The next step for me. So first was the Navy, then was Indiana, and I went to India. I skipped a step because I was a serious French horn player when I was in school, high school, and grade school. Practiced like 3 hours a day and was pretty good at it. And I did have one semester of college before going to the Navy, and at a music program. But after I came out of the Navy, I thought, no, because you really can't make that up. It's a serious endeavor, and you're competing against people who actually did not take 2 years off to be a gunner's mate aboard the USS Hornet. So I found myself taking economics classes because I told you about my kind of gap 6 months at McDonnell and Company, where I got the service in 1967. So that preceded my return to college in 1967, in fall of 67. So I had like, I guess 6 months on a trading desk. And I watched all these people. I made $65 a week, and the other people were institutional salesmen who would spend all day on the phone, many of them earning more than $100,000 a year, which was the equivalent of, I think, well over $1 million now.
Wow. Yeah.
And the value add of an institutional salesman in those days was getting to the office early, having read the Wall Street Journal, and calling people up and telling what was in it. That was the value add. So I thought that sounded like a very pleasant way to make a living. And
I love that. Yeah.
And so I studied economics, and when I got, and that was passed over a couple of years in grad school. That was of no particular account. To your question, Chris. Then I got to, I wanted to be in journalism. So I went to the Baltimore Sun.
That's right.
And it was a very good place to be a cub reporter. And after a year or so of covering fires and writing obituaries and writing police stories, there was a vacancy on the financial desk, which was the lowest status section of the paper by far, with the exception perhaps of like the shipping agate page. This little type was
especially in Baltimore. I'm sure crime. And I think of the show The Wire.
Yes, I'm sorry you brought that up, because I have to confess something now. I thought this is in 1972 through late 74, I thought that Baltimore was a peaceful city. I'd go around to these police stations. I'd say to the cops, "So what's going on?" They said, "Nothing." All cool. And then a few years ago, I watched The Wire, and I said, "What was I doing?" Or so Pat, we'll draw the veil of charity over that portion of my journalistic career. So, Chris, to answer your very long way to answer your question, I came first, I suppose, to economics, and then decided to I wanted to be in journalism. So I did that, and then went to the Sun for a few years, and then went to Barron's for many more years, from 1975 until 1983 when I started Grants. So I was there that's it.
Well, and I mean, so you've been publishing for about 40 years now. I guess it is 40.
Yeah, 41.
41, but who's
41, yeah.
counting? I'm curious. You seem like a very vibrant guy, and you've been doing this a long time. And I mean, obviously, we're talking today about a lot of things that are you're pretty up to date on everything. What's your secret to being so vibrant and keeps you getting up in the morning and publishing, pretty thorough publication. I read through the ones that you sent me. I guess it's almost like a life secret. How have you stayed so vibrant? How do you continue to stay so vibrant?
Part of it is habit, what keeps me going. But that's kind of a cop out because I certainly could retire. I could retire, but I could continue doing some of what I do. I write books too, and I could certainly do that in retirement. But I happen to love markets, and also I want to make sure that I'm the guy who writes the obituary on this monetary stuff while publishing grants. Huh?
Oh, when you say habits, like what are those habits specifically? I'm curious. Like what do you do on a daily basis that
Well,
are
I'm glad you asked, Ryan, because I see out in front of your building there's some fabulous scaffolding. Why do I say scaffolding? Because New York City scaffolding is excellent for doing pull-ups. So I urge you and you too to when entering and leaving the building, rip off, start with one, and work your way up. And you'll feel better about yourself, and you'll make a spectacle of yourself. And people will say to you, "Why are you doing that?" And you say, "Because I like the feeling of cold metal on my hands." And
I don't know
so
if I don't know if you're kidding or not.
no, I'm not. I do it. I do. We live in Brooklyn Heights. Scaffolding stuff all the time. We'll never come down. I do pull-ups, push-ups, sit-ups. You see me with a cane. That's because I've had too many damn birthdays. But I still, I work out every day.
What time do you get up and work out?
Well, I sleep badly, so I get up, at 5 or something. I also advise. Oh, this is good. I read something long ago. And this jumped out at me. It was not an especially startling piece of advice, but the advice was to marry a happy person.
Wow, that's great advice.
And Patricia and I have 51 years under our belts.
Wonderful.
And thank you. And she's wonderful. And so you never know exactly. I was head over heels from the first moment, and it happened that we have made a wonderful life together. But
How did you meet?
We were reporters of the Baltimore Sun. She was the quite glamorous fashion editor, and I was the evidently dashing police reporter.
The dashing part went without saying, Jim. We knew. So how did you charm her?
I think I was ask her. I was astonished. And then also, I'm not a great screen reader, so I always carry a grants bag. In that bag is my latest book. I'm reading a copy of the London Spectator, which publication I love, or the Post, or the Wall Street Journal. So always be reading, always be sweating, and never ever give in to these people. You know who they are. We know who they are. I'm thinking not to sound like a complete screwball. I'm thinking particularly of the monetary oppressors who are keeping us skeptics on the sidelines, waiting for our shot at value. If I may presume to lump you into my somewhat dwindling band of brothers.
Well, Jay Powell's on my hit list, so
I think he's just trapped in what the Fed thinks it's about. The Fed, I think, honestly believes that its mathematical models are helpful, that they lead the way to the future. It seems to think that there are no substantial, untoward consequences to its interventions. The Fed, little known, certainly little remarked fact, the Fed is broke. The Fed is BROKE, broke.
Yeah.
And you can see that on its balance sheet every Thursday. Look at stated capital of $43 billion, then look at its obligation to pay the Treasury someday at no stated rate of interest, which is to say no interest rate at all. Its operating losses, which have been accumulating to the point of, $100 and something billion. So the Fed, I do fault, I think Jay Powell's an honest man, but I think that the Fed is dishonorably muffling its terrible financial predicament, and all the the people who don't think much about it are prone to say the Fed's independent or should be independent of the Treasury. The Fed is a financial vassal of the Treasury. How could it be independent? It was into the Treasury for $150 billion, whatever it is. I haven't looked recently.
Well, one thing I've observed, Jim, is through your career, since, I started a little later than you, but you always wore a bow tie. Did you ever not wear a bow tie?
I think one Saturday in 1958.
Okay.
I started, I forgot when I started wearing them, but I was a panelist on Wall Street Week for a time, and my father tuned in, and he said, "You look like Dave Garroway." Remember him? The only guy who's laughing is Bob.
Yeah, I was going to say, I have no idea who that is.
It's just a generational thing. Dave Garroway was this, I think CBS, maybe CBS or NBC, but television personality. His watermark was the bow tie. And another thing, I dress the same way that I did when I first day of work as a clerk in 1967. I can't tell you why, except that it just feels right. But I walked down the street as if I stepped out of a movie set pertaining to the second Eisenhower administration.
So we asked everyone this, and I happen to be a big music buff. So I'm just curious, what was one song or maybe full album you heard for the first time that you feel like it completely changed your perspective on life?
Count Basie Band, April in Paris, 1955.
Beautiful.
1956 was the year that Elvis Presley astounded the world by appearing on what was then the premier Sunday night,
Ed Sullivan Show?
Ed Sullivan Show, yeah. And so all of a sudden rock and roll was like Bitcoin at the time. And all musicians who had gone to Juilliard, spent 3 and 4 hours a day in a practice room, were subsisting on, meat once a week and a couple of slices of bread. All these people were even more out of work, even broker, because of this guy who really, they used to say in Nashville, "Do you read music?" "Yeah." "Well, okay, that won't set you back too far. Just forget it." Right. So the whole world changed, and what was old and revered and what was built upon years of commitment and study and virtuosity, that's all right, done. You're done. And that's one of the great things about capitalism. It's the least sentimental.
Creative destruction.
Yeah. It's not what doesn't feel so very creative if you're on the destructive end. But so things change sometimes in a heartbeat or a wink, and that takes us back to things like Bitcoin. It's a fake, right? Yeah. Well, yeah. You can't know. You can't know. You can have really strong opinions, but you hold in reserve a respectful and humble opinion about how the world can change without your permission.
Thanks for listening to the Payne Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.